investment point of view, I guess my first investment was really, I think buying my first apartment with my wife, and that was roughly around sort of 1990, and that was, I think we'd bought an apartment, turned out it was on a relatively busy road before we'd sort of moved in. Some backpackers moved next door. We spent one night there and decided that we needed to, this wasn't for us, and we needed to kind of move out. And, I think that as a, not so much as an investment, but, I think as a broad sort of learning about, thinking about, I suppose investing in that context was, quite a sort of, there's a lot that sort of came out of that. I mean, one was do your research.
Yeah, that bit of data.
Well, I think if we'd done done better due diligence, we would have probably understood a lot more of the risks that sort of were around that. Yeah. I think we were probably jumping onto a bit of a trend. So we probably rushed in, given that sort of fear of missing out. And I think that's clearly the wrong thing to do. And I think probably the other sort of takeaway from that was that you shouldn't be afraid to cut your losses. If something isn't actually working for you, then cutting your losses does make some sense. And so we were, I think after that first night, the next thing we did was kind of work out how do we get out of here. And subsequently, I think that was probably the best thing we could, or we ultimately did.
Action.
Well, we did. And it's like, well, we can stay here and be miserable, or we can actually cut our losses on that. And I think a lot of those sort of lessons in terms of, make sure you do your research. If it doesn't feel right, don't do it. Yeah. Don't be afraid to sort of cut your losses. Have, probably subconsciously influenced the way I've sort of thought about investing subsequently. In terms of a professional career as an investor, I guess mine has probably come in two parts. The first part, and as I sort of started work, I effectively started investment operations, but then moved into an economics role. So it was much more a research and an advice-based role, but allowed me to kind of build a fairly strong knowledge of, pretty much everything. So from the domestic economy, interest rates, bond yields, the global economy, commodities, sort of moved into a multi-asset environment, sort of understanding how different assets worked. And so, I spent a lot of time actually learning the building blocks, thinking about how markets worked, before I was actually given the responsibility of making actual investment decisions.
Can you explain in relatively simple terms the philosophical difference behind the portfolio construction for objective-based investing as opposed to your traditional 60-40 sort of balance?
I think there are, probably understanding, why we sort of shifted focus, or why we developed the real return or the objective-based approach, actually had its genesis really in running a balanced fund, and partly in the timing as well. So recall, so going back to the mid 2000s, so prior to the global financial crisis, and if you recall through that period. Particularly from sort of 2005, 2006, there was structured credit was really starting to emerge and feature the investment debate and client portfolios. There's a lot of leverage sort of in credit markets. Asset prices, equity markets had been performing quite well. Valuations were deteriorating. There's a whole bunch of risks starting to really permeate financial markets, and we were becoming very concerned that sort of running a balanced portfolio, which had a sort of 60% equity benchmark, that even if we wanted to avoid some of the sort of the potential carnage that we thought might come if this sort of bubble in structured credit and all these sort of other problems really erupted, then we really couldn't do that much to protect our clients. All we could really do is reduce our equity exposure to the lower end of a range, but we'd still have a lot of equities. And so, worst case happened, we'd perform relatively well, so we'd outperform our benchmark, but our clients would still lose money. And for most clients, that's not what they expect. And you sort of think through, well, what are the, why is that? Well, a lot of it's because of that embedded equity risk in portfolios and the rigidity of those sort of fixed benchmarks, the dependence on the performance of equities. So what we decided to do was really say, well, let's take away those constraints. Let's think about, well, if we were building a portfolio today and we didn't have those constraints and our objective was, you know, a reasonable return above inflation and to try and avoid the losses that occurred through a period like, say, the global financial crisis, how would we do that? How would we construct it? And, you know, we did that, and that was effectively the basis for the real return strategy, or, you know, that objective-based approach. But in essence, it was really taking away, you know, having the ability to own those assets in that, you know, whatever proportion you saw necessary to achieve the actual objective, not to be sort of weighed down by some sort of arbitrary benchmark that might have worked historically, but given where sort of markets were at a point in time, probably wouldn't work going forward.
So does that mean you basically use the same ingredients, all the same ingredients, just in no constraints around how much of it you use at any particular given point in time?
Yeah, I mean, I think that is, in a way, what we're trying to do. I mean, we haven't invented any new asset classes. I mean, there's still largely equities and debt and sort of derivations of those. It's really about how you put, or how we put those together, that ultimately matters. And if it doesn't make sense to own equities, then we won't. If it doesn't make sense to have a lot of US equities, then we won't. If the return potential is really in currency markets, or we can achieve our objectives through owning credit, that's where we want to go, not to be constrained by, as I say, some sort of arbitrary benchmark.
So let's get a little bit into the current landscape. What do you and your investment team what are you spending a lot of time thinking about at the moment? Where are you focused? Where do you see opportunities, risks when you look across the asset class mix that you've got available to you?
I think we're sort of coming to a pretty interesting point in sort of the broader investment cycle. I mean, notwithstanding 2018 was a more difficult year. I mean, by and large, and the lead up to that has been, investors have enjoyed sort of pretty strong returns. So I guess, the question is always kind of what comes next, and I suppose I'd sort of break things down into kind of some very short-term factors and sort of medium to longer-term factors. I think on the short-term front, I think there's probably a few that we're sort of seeing, really, and a lot of them are kind of a bit unforecastable or unknowable. And I think things like Brexit, it's very hard to know how that's actually going to sort of play out. You've got, Trump versus China on tariffs. You've got Trump versus effectively the US legislature on the border wall. We've got, Fed policy, doing a bit of a backflip in recent weeks as markets have sort of rioted and forced a bit of a rethink. And so there's a bunch of things I think that are a little difficult to forecast, but are clearly having an impact on markets in the short run. And while they're difficult to kind of know exactly how they'll play out, we need to think about how much risk we're prepared to take in portfolios to manage through that. I think if I sort of extend my investment horizon a little bit, I think there's probably a couple of key things. I mean, one is that we're coming out of, I think, a period of pretty strong global growth, very low inflation, and very accommodative central banks. Rates have been low. Notwithstanding some tightening in the US, rates are still pretty low. Central bank balance sheets have been sort of expanded, through QE programs and the like. And so liquidity up until probably 6, 9, 12 months ago was actually very supportive of markets. But I think that's sort of starting to turn. It's getting a bit. Central banks have less of a kind of a free option to kind of support economies. So I think that's something that's very important to kind of watch how that plays out. I think another thing that's worrying us a bit is, again, sort of focused on the US, because it will be probably the driver of, or the epicenter of kind of how things develop, is really the risk of a recession unfolding in the US. And a lot of the analysis, we don't want a recession to occur. You know, we're not
Yeah.
doomsayers in that sense, but if it does occur, it will be the thing that really turns markets on their head. And you know, we want to be prepared if possible, and we want as much forewarning so that we can kind of position for that. You know, avoiding that sort of experience will be, you know, very important in terms of how investors generate sort of long-run returns from here. And the indicators that we're looking at are sort of suggesting that, you know, there is a, you know, reasonable chance of that occurring, you know, probably within a 1 to 2 year time frame. So probably towards the end of this year, markets will be starting to really focus in on that risk. And if you add to that the fact that, you know, Chinese growth is moderating, you know, Europe's still struggling to sort of get its, you know, to get some sustained momentum. You know, the UK, well, you know, who knows how that's likely to sort of play out. And Australia has its own problems in terms of, you know, the sort of the working out of the housing boom, the decline in house prices, and how that sort of flows through to income. So I think the broader growth environment is becoming a lot murkier, and I think the risk of a recession, you know, something even here, you know, something we haven't had for, you know, nearly 3 decades, could happen on a sort of, you know, over the next sort of few years. So I think there are some things that are changing, and I think in that environment, you know, that's economies, it's not markets, but I think markets are still priced for, you know, probably maybe not perfection, but for a pretty positive environment going forward. There's not a lot of risk. Price, risk premium are quite narrow. So I think for investors, one of the key challenges, and I think this is in essence the key challenge we have, is how do we generate returns for investors in an environment where the things that have generally supported markets and, you know, supported returns are actually turned around and are now making it a bit more challenging.
So is the starting point for you against that backdrop, is with this real return objective, is the first thing to eliminate or reduce the exposure to assets that are likely to generate a negative return? Is that how you start thinking about it?
Well, there's 2 things we need to do. One is we need to still try and generate decent rates of return, you know, close to our objective. So we've got to find things that are actually likely to produce positive returns. So what do we like at the moment? You know, it's probably not the entire equity market universe, but there's parts of that look okay. So Japan looks pretty cheap to us. You know, Japanese PE multiples are trading at about 11 times. You know, as far back as we've got data, that's about as cheap as that market could be. Now, there's some risks around that, but you know, if you sort of pull it back to the things that matter, buying cheap assets generally leads to decent returns. That's a market that we think, you know, could do reasonably well over the next couple of years. Australian equities actually look okay. You know, we're not going to make spectacular rates of return out of Australian equities, but you probably do okay from Australian equities on a kind of a 1 to 3 year view. Yeah. There's other things that we like as well. So currency markets we think will be an important source of return. You know, it's probably slightly controversial, but
Seems quite volatile. Seems very hard to predict.
well, in some ways, yeah. I mean, but assets are hard to predict, but I think at extremes there are opportunities, and you know, it's the same story with currencies. So sterling, for example, is a currency that's had a lot of bad news to deal with. A lot of that bad news we think is in the price. And you know, if we get a reasonable outcome to the Brexit situation, then that could realise some of that value. So we think there is decent upside over the medium term for to sterling. We don't like the Australian dollar, right? So owning the US dollar over the Australian dollar could be a source of return as well. So we're sort of looking within equity markets, within currency markets, to try and find positive assets that we like. And I think another thing that's going to be important in terms of generating return is, I think asset allocation is going to come back with a vengeance. And what I mean by that is we've been in a period of very low volatility. Again, take last year out of it where we did see a couple of blips, but by and large over the last few years, volatility has been very low. It hasn't mattered that much what you've owned because everything's kind of done similar things. Yeah. But as volatility starts to pick up and as we start to get some differences evolving in terms of risk premium in assets, some of these sort of country risks, rolling through, some of these geopolitical risks destabilising markets, that's going to start to throw up opportunities. And I think the ability to capture those opportunities and avoid risk through, at an asset class level, through active position changing, I think will be another source of return. So they're the sort of things we're looking at to generate returns. The flip side of that is is to avoid the things that we think are going to lose money. And what are they? Well, there's probably two that I think are probably worth noting. I mean, one I think is the US equity market. It's structurally and cyclically expensive. And we think over the medium term likely to deliver investors close to nothing in terms of returns. The second thing is really looking at sort of probably the leveraged loan market, sort of higher risk parts of the credit universe. I think one of the consequences of easy money and the search for yield has been that money's flowed. Investors have been able to access credit that probably shouldn't have been able to, and on terms that they probably shouldn't have been able to access, and at rates they shouldn't have been able to access. And I think as the cycle turns, whether it be the policy cycle or whether that be the growth cycle, I think there's going to be some fairly nasty experiences kind of roll through that sector. So, we want to sort of focus on quality. We want to focus on those things where there's value. We want to remain appropriately liquid and able to really capture opportunity as some of that volatility unfolds.
You've sort of talked about wanting to with the objective-based returns, deliver on a sort of a inflation plus number. You've also had the chance to run the strategy. You sort of mentioned a few periods of dislocation. Yeah. Can you give me a sense of how you've delivered against those objectives? Do you get the returns? And more importantly, has it given you that sleep at night factor when you most want it, sort of when markets really draw down?
Well, it probably hasn't given me the sleep at night factor, but I suspect, hopefully it's given our clients, and, the sort of sample of direct clients that I talk to, I think are generally pretty comfortable. They're very supportive because it's doing what they wanted it to do. In terms of have we achieved our objective, I think we've certainly achieved, in my view, the risk objective. We've sort of come through, while we have been tested at times, the last few years have generally been reasonably good, so we haven't had a lot of sort of major drawdowns. But where we have, whether that be 2015 or 2018, by and large the portfolio has performed pretty well. It's either been sort of slightly up to flat to maybe down a little bit, but certainly compared to other markets, it's done what we believe it should have in those periods. We're not as happy on the return side. I think we were too early reducing our exposure to equity markets in 2017, and markets did certainly run on, particularly towards the end of the year, and we were too defensive. So that we didn't make as much money for our clients as we should have through 2017, and I think that's something we've sort of learnt from. We're trying to improve the process, but with all these things, it's a fine line between hanging on too long and getting out too early. And I think for us, we do believe valuations matter. That does mean we do tend to get out of expensive markets, often before others, which means we may leave some return on the table. But our belief is we pick that up when markets go the other way.
I always like to pull a few skeletons out of the closet. So we find it's a great way to pick up some lessons for our viewers. So the question is, can you think of a mistake or a particularly challenging time in your career that taught you a lesson, and what that lesson is and how it makes you a better investor today?
I think one of the things I have learned is that you never have all the answers, and I think people like to have strong views, but I think there's only so much confidence you can have, just given the uncertainties. Markets are about the interplay of policy, politics, people, and all those things are reasonably unpredictable. So I always approach every situation with a degree of I guess, humility, not knowing kind of, treating everything different. We can't sort of trade on past successes. We need to kind of view everything effectively with a clean slate. So, I use, I guess, more difficult periods in markets to try and learn. I think probably one of the most important experiences I think I've had was really going back prior to the global financial crisis. So we're talking here around 2006, 2007. And I remember we were running in our fixed income portfolio. We were in a model portfolio for a particular client, and I was asked to come and present to their professional development day. And I turned up at their PD day. And they were very unhappy with us because we were in the portfolio with a very well known at the time hedge fund that had been very heavily invested in structured credit. And of course, in that period, in the lead up to the global financial crisis, these things had done extremely well. In fact, this particular hedge fund, I think, was hedge fund of the year. And so, they were very happy with this other manager and very unhappy with us because our sort of small positive returns were significantly lagging this other manager. And so it wasn't a pleasant experience, and I sort of did my best to kind of articulate why we were positioned how we were and what we thought some of the issues were. And 12 months later, I sort of went back to that same PD day, and so this was late, I think, 2008. And it was completely the reverse situation. That particular hedge fund had basically collapsed. It had cost their investors a significant amount of money, and the gloom in that room was palpable. I mean, I'd go as far to say as I think there were tears as they were kind of describing what had happened. And the view on us was quite a bit different. And why I think that's important is, for a couple of reasons. I mean, one is, this is a long-term game. We need to make decisions that aren't right, for today, tomorrow, next month, or even this year. It's a right over a reasonable time frame. I think the other thing that's important is, and sort of reinforced to me at that time, was that we as custodians of client money, it's not our money, it's our clients. It's not even the advisors that are in the room, it's individuals that sort of sit on the other side of that have saved hard to generate this. It's very important to them that they get the results that they need, that we need to kind of make decisions for them, which in the short run may be painful to us, but are actually in their long-term interests. And I think you can never forget that it's individuals. It's not the institutions, it's not the research houses, it's not the advisors' money that you're dealing with, it's individuals who it's very important to them that you do the right thing for them. And I think that's kind of framed a lot of the way I think about investing. I like to know, you can't know everyone, but I do like to have the face-to-face conversations with the actual individuals, and I'd like my team to have those conversations as well, so they realise that there are real people, it's real money, and we're accountable, and we've got to make decisions for them that are in their long-term interests.
Great. Well, Simon, I appreciate you coming in today. I learnt a bit about objective-based investing.
Good.
It's obviously really valuable for us to get access to someone that's been investing over such a long period of time. Some great lessons there, so thank you very much.
Okay, thank you.